The Precious Metals Week in Review, December 11th, 2015. Brought to you by Precious Metals International. This week saw renewed volatility in the stock market that appears to have largely been driven by the further collapse in the price of crude oil and signs of continued economic weakness and further depreciation of the yuan in China. The number of Americans filing new claims for state unemployment benefits jumped by another 13,000 claims last week, even as the holiday shopping season, typically a time of surge in hiring in part-time jobs, entered full swing. Economists had projected that the unemployment data for this week would remain steady at 269,000 claims, but they clearly missed the mark. The previous week's data remained unrevised at 9,000 claims, pushing the initial claims figure back to a 5-month high of 282,000. The second week of significant gains in unemployment claims, combined with the collapsing price of oil and jittery global stock markets, places the Federal Reserve in an awkward position when it conducts its final FOMC monetary policy meeting of 2015. Former U.S. Representative Ron Paul, when discussing the recent weakening economic data with CNBC this week, said that if the data pressures the Fed into holding off on its rate hike, that it looks like it would be a real shock to everybody, including the markets, if they don't hike. Mr. Paul, who up until recently was highly vocal in his belief that the Fed would not move this year at all, said, "In a way, it's amazing the amount of attention it's been getting when you think what 0.25% of interest means." China allowed its currency to fall again this week, pushing the yuan, also called the renminbi, to a 4.5-year low against the US dollar. The move immediately spooked markets, sending stocks tumbling lower as investors recalled the results that August's 2% devaluation in the yuan had on stock markets. The move, coming just before the U.S. Federal Reserve holds its final FOMC meeting for the year, immediately sparked further uncertainty in the Fed's ability to move forward with its clear desire to raise interest rates this month in a bid to normalize markets again. In other China news, more brokerage firm executives have gone missing this week, including Guangchang, commonly referred to as China's Warren Buffett. According to private investment firm Fosun International, it has not been able to reach Mr. Guangchang since Thursday afternoon. According to a report by Kixin, witnesses saw police leading Mr. Guangchang away from the Shanghai airport after arriving on a flight from Hong Kong. On Sunday, CITIC Securities, China's largest brokerage firm, said that it also was unable to contact 2 of its own top executives. Chinese stocks continue to see increased volatility, especially as these disappearances at top brokerage firms continue to occur. On Monday, the U.S. and Singapore announced that the U.S. would be deploying P-8 Poseidon surveillance aircraft to Singapore in response to China's continued military expansion in the South China Sea. The move was just the latest in a series of increased operations to monitor China's artificial island construction efforts in the much-contested Spratly Islands. China maintains that the construction efforts are simply to preserve the reefs and allow China to maintain maritime safety in the region, but the U.S. notes that there are at least 4 airfields under construction on the islands that would be able to service most military aircraft. In Europe, following the Paris terror attacks, the far right in France appears to be gaining more power in the government. In regional elections over the weekend, the National Front Party in France made strong gains, taking 28% of the projected vote nationwide, according to data from the Interior Ministry. There will be a second round of votes on December 13th, and if the far-right group makes further gains, it could significantly change the political landscape in France as they move towards presidential and parliamentary elections in 2017. In London, the Metropolitan Police were called to Leytonstone Tube Station on Saturday in response to a man attacking people with a knife. The attack is being treated as terrorist-related, and witnesses described the individual as shouting, "This is for Syria," and "all your blood will be spilled," as he wielded the knife. One man was seriously injured and the knife wielder will be charged with attempted murder as a result of the severity of those injuries. The UK police have increased patrols on London's tube system as a result of the incident, and Commander Richard Walton, head of the Metropolitan Police's Counter-Terrorism Command, said in a statement, "We are treating this as a terrorist incident. I would urge the public to remain calm but alert and vigilant." The threat from terrorism remains at severe, which means that a terrorist attack is highly likely. The Bank of England (BOE) opted to leave interest rates at record lows following its meeting on Thursday, noting that inflation remains subdued, aggravated by the continued fall in oil prices. Economists had widely expected the BOE to hold rates steady, so market reaction was muted. The central bank noted in its meeting minutes that downside risks to growth in emerging market economies remained, however, with the risk of an acceleration of capital outflows in reaction to any increase in U.S. interest rates. It would seem that even the Bank of England feels that the U.S. Federal Reserve risks damaging fragile emerging markets if it chooses to raise rates. U.S. crude oil prices collapsed below $36 this week as OPEC refused to cut production, and some cartel members actually saw a slight increase in output. The glut of oil supply, combined with a warmer than usual winter and the Chinese economic slowdown, has continued to place serious downward pressure on the price of oil, which now sits at levels not seen since 2009. The euro began the week drifting slightly lower against the US dollar, but the dip accelerated into Monday morning. The euro quickly found its floor on Monday and turned around to move higher until late Wednesday. The euro dipped against the dollar through Thursday and then began to see another reversal to the upside on Friday. The euro appears set to close the week higher against the US dollar. The Japanese yen dipped lower against the dollar at the start of the week, but then began drifting higher through Wednesday morning. On Wednesday, the yen surged suddenly higher and then began trending lower in a series of peaks and valleys through early Friday morning. On Friday, the yen surged higher again and appears set to close the week higher against the US dollar. Moves by China to further devalue its currency and increasing uncertainty over the Federal Reserve's reaction to the latest economic data available when it begins its two-day Federal Open Market Committee meeting next week, will likely have markets on edge at least through midweek. Most analysts feel that there is a better than 80% chance that the Fed will decide to begin raising interest rates at the conclusion of its FOMC meeting next week. The continued suppression of oil prices, increasing market turmoil, inflation that is nowhere near the Fed's target, and a recent two-week rise in applications for state unemployment assistance in the U.S. may all still act to stay the Fed's hand, however. If the Fed fails to initiate its liftoff in interest rates, stock markets may consider that a tacit acknowledgement that the U.S. economy is nowhere as healthy as officials would like for everyone to believe. Investors have been pulling money out of both stocks and bonds as the meeting dates approach, apparently waiting on the sidelines to see what the outcome will be. Any indication that the U.S. economy could be weakening as we end the fourth quarter could trigger a run for safer haven assets as investors seek places to safely store the cash they've liberated from stocks and bonds. As the day of the meeting approaches next week, expect volatility in the stock market to continue and mainstream media speculation over the actions of the Fed to run rampant. This will likely be the most discussed FOMC meeting for the Federal Reserve in the last decade, and making investment moves based on nothing but emotion and media headlines ahead of the meeting could be a serious mistake. Mainstream media will likely ramp up their anti-gold rhetoric again, especially if investors continue to pull their money out of stocks and bonds ahead of next week's meeting, in an effort to steer investors away from precious metals and back into the very stocks they seem to be abandoning in droves. The continued economic weakness in China, coupled with instability in their own stock markets as executives at brokerage firms disappear under police escorts, could also continue to have a dampening effect on global markets next week. The People's Bank of China, PBOC, allowed the yuan to further depreciate against the dollar this week, sparking comparisons to moves in August when the central bank devalued their currency by 2% overnight. Public comments from the PBOC on Friday stating that it intended to change the way it manages the yuan's value also acted to send markets lower Friday. The PBOC said that it is considering measuring the yuan's exchange rate against a basket of currencies rather than the US dollar alone, as it was previously measured, and these statements served only to reinforce investor opinions that the yuan was on the verge of depreciating even further. And so we find ourselves entering another weekend with a high degree of global uncertainty. China will once again release some key economic data over the weekend, which could have a detrimental effect on stocks. Next week, we'll likely see emotions running high among investors as the mainstream media blasts the airwaves with speculation over the Fed's moves. Pay careful attention to global news outlets for events that could have a positive effect on precious metals prices, and seek out buying opportunities to acquire additional physical precious metals as part of a well-diversified investment portfolio. Investors should remember that fundamentals and not emotion should play the largest part in their investing decisions. Yet another mining company, Anglo American, announced restructuring efforts and massive job cuts in an attempt to keep their business alive as current price levels continue to erode the profits and very sustainability of their business. If investors, flush with cash from selling stocks and bonds ahead of the Fed meeting, find themselves disappointed with the outcome of that meeting next week, they might turn their eyes back to precious metals as global economic and geopolitical uncertainty begins ruling the day once again. A sudden surge in demand for a product which has seen serious production cuts could trigger a sudden upsurge in pricing for that product that the unprepared investor would be ill-equipped to take advantage of. Wise investors have continued their course of using temporary price dips to accumulate more physical precious metals products for their investment portfolios, recognizing from the mining company's own statements that current price levels are not profitable, that they are likely purchasing these products at a serious discount. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, December 11th, 2015. Brought to you by Precious Metals International.